Welcome back to the channel. Today, we're going to tackle one of the most commonly asked questions in the world of investing. Real estate versus stocks. Where should you invest your money? Now, I'm sure you've heard both sides of the argument. Some people swear by the security of real estate, while others praise the ease and returns of the stock market. Both investment options can be great, but they're very different in terms of risk, time commitment, and how you make money. So, in this video, we're going to take a deep dive into the pros and cons of real estate and stocks, compare them side by side, and talk about how to choose the best option based on your personal financial goals and circumstances. By the end of this video, you'll have a much better idea of whether you should invest in real estate, stocks, or maybe even a combination of both. Real estate investing. First, let's talk about real estate. Real estate investing involves purchasing physical properties, like residential homes, commercial buildings, or land, with the goal of generating income, whether through rental income, appreciation, or by flipping properties. One of the big attractions of real estate is that it's a tangible asset. You can see it, touch it, improve it, and control it. Three main types of real estate investing. Rental properties. This is the classic real estate investment. You buy a property, rent it out, and collect rental income. Ideally, your rent will cover your mortgage and other expenses, giving you a steady cash flow each month. House flipping. House flipping is more short-term. You buy a house, renovate it, and sell it for a higher price. Flipping can offer high returns quickly, but it also involves a lot of risk, time, and effort. Real estate investment trusts, REITs. For those who want to invest in real estate without directly owning a property, REITs are a great option. REITs are companies that own and operate income-generating real estate, and they pool money from multiple investors to buy large properties. REITs can be publicly traded like stocks, which makes them a more liquid real estate investment. Pros of real estate investing. Tangible asset. One of the biggest advantages of real estate is that it's something physical. You own a property, and it gives a sense of security that many people value. Unlike stocks, which can feel abstract and paper-based, real estate is something you can physically improve and control. Steady cash flow. With rental properties, you can generate monthly rental income. If you own several properties, this income can add up significantly. For many investors, this consistent cash flow is a huge draw of real estate. Once you've paid off the mortgage, the rental income could be mostly profit. Appreciation potential. Historically, real estate appreciates over time. This means the value of your property could increase substantially, especially if you buy in the right location or improve the property. According to many long-term investors, real estate provides an inflation hedge, as property values typically rise along with inflation. Tax benefits. Real estate offers many tax advantages that stocks don't. For example, you can deduct mortgage interest, property taxes, and depreciation. Depreciation allows you to reduce your taxable income, even if your property is appreciating in value. If you sell a property after holding it for a long time, you can benefit from capital gains tax, which is lower than income tax. Cons of real estate investing. High initial investment. One major drawback of real estate is the amount of money required to get started. Unlike stocks, which you can buy with a small amount of money, real estate typically requires a substantial upfront investment. Even with a mortgage, you need to put down 20% or more for a down payment, plus cover closing costs, repairs, and other expenses. Illiquidity. Real estate is not an easy asset to convert into cash quickly. If you need money fast, it can take months or even years to sell a property, and you may not get the price you want. This makes real estate a long-term investment that ties up a lot of capital. Ongoing costs and management. Owning property comes with ongoing responsibilities. You'll have to pay for maintenance, repairs, property management fees, property taxes, and more. If you're managing rental properties, you also have to deal with tenants, vacancies, and sometimes even legal issues if things go wrong. Market risk. While real estate tends to appreciate over the long term, it is not without risk. Economic downturns, changes in neighborhood dynamics, or housing market crashes can cause property values to fall dramatically. Just think back to the 2008 financial crisis when housing prices dropped significantly. Stock market investing. Now let's talk about stocks. When you invest in stocks, you're buying ownership shares in a company. As the company grows and becomes more profitable, your shares increase in value, and you can benefit from capital appreciation or dividends. 3 main ways to invest in stocks. Individual stocks. This is where you pick and choose specific companies to invest in. You might buy shares in big-name companies like Apple, Amazon, or Tesla. The value of your shares rises and falls with the performance of that particular company. Index funds. Index funds are a great way to invest in a broad market. For example, an S&P 500 index fund buys shares in all 500 companies that make up the S&P 500 index, giving you instant diversification and a lower risk profile compared to investing in individual stocks. Mutual funds. Similar to index funds, mutual funds pool money from many investors to buy a diversified portfolio of stocks. The key difference is that mutual funds are actively managed by fund managers who try to outperform the market, but they come with higher fees. Pros of stock market investing. Low initial investment. One of the biggest benefits of investing in stocks is that you can start with a small amount of money. Many brokers allow you to buy fractional shares, which means you don't need a lot of capital to get started. Even if you only have $100, you can begin building a stock portfolio. Liquidity. Stocks are much more liquid than real estate. You can buy and sell stocks within minutes, and the money will be in your account within a few days. This is ideal if you need quick access to your cash, unlike real estate, where selling can take months. Diversification. With stocks, it's easy to diversify your investments across different sectors and industries. You can invest in tech, healthcare, energy, and more. This diversification lowers your risk because your money isn't tied to the success of a single company or industry. High growth potential. Over the long term, the stock market has historically delivered solid returns. For example, the average annual return of the S&P 500 over the last few decades has been around 7 to 10%. Compound growth over time makes stocks an excellent choice for long-term wealth building. Cons of stock market investing. Volatility. Stocks are more volatile than real estate, meaning their prices can fluctuate wildly over short periods. It's not uncommon for stock prices to drop 20 to 30% in a bad market year, which can be stressful for investors who don't like seeing large swings in their portfolio. Emotional investing. The stock market's volatility can lead to emotional investing. Investors might panic during market downturns and sell their stocks at a loss, only to miss out on the recovery. Staying disciplined is essential, but it's not always easy when markets are turbulent. No control. When you invest in stocks, you're putting your money in the hands of the company's management. Unlike real estate, where you can actively manage your property, you have no control over the performance of the companies you invest in. Poor management decisions or unforeseen events can affect your returns. Key considerations for choosing between real estate and stocks. Now that we've discussed the pros and cons of both real estate and stocks, risk tolerance. Are you comfortable with the potential for large price swings? Stocks can be very volatile in the short term, but historically, they've delivered strong returns over the long term. If you're someone who prefers more stability and doesn't want to worry about the daily ups and downs of the market, real estate might feel like a safer bet. However, real estate is not without its risks, especially in times of economic downturns. Time commitment. How much time are you willing to dedicate to your investments? Real estate often requires a lot of hands-on work, especially if you're managing rental properties. You'll need to deal with tenants, property maintenance, and the occasional repair emergencies. Stocks, on the other hand, can be much more passive, especially if you invest in index funds or mutual funds. Once you've built your stock portfolio, there's very little you need to do on a daily basis. How soon might you need access to your money? Stocks are highly liquid, which means you can convert them into cash relatively quickly. Real estate, however, is much less liquid. If you need to sell a property, it could take months, and you might not get the price you're hoping for. Cash flow versus growth. Are you more focused on generating steady cash flow or growing your wealth over time? Real estate, especially rental properties, offers the potential for consistent monthly income. Stocks, on the other hand, offer more long-term growth potential, especially through capital appreciation. Dividends from stocks can provide some cash flow, but it's usually less reliable than rental income.